Okay, Jeff, you ready?
Yes.
All right, so let's
Awesome.
start this. Hold on.
Okay. Let's talk a little bit about who we are, I guess.
That's right. All right.
Awesome. There we are. The Chenore Group. 42 years of combined experience. That's just you and I, right, hon?
Yes, that's just you and I.
This is our third market shift, the third time that we've had something drastic happen in the real estate market that causes disruptions and causes changes and causes people to have to adapt. We've been selling real estate in South Florida since 1996. True. We both have broker's licenses, not a salesperson license. That's for a long time. I think I've been a broker for 21 years, and you've been a broker for 16.
I don't even remember, probably 16, yeah.
Yeah, 16 years. And I guess we've sold about 1,200 houses just in Broward County, but of course our business has taken us into the Keys. Our business has taken us into North Florida, Central Florida, West Florida. I like to tell everybody that we sold a 125-acre cow farm up in Arcadia, right? Remember doing that?
I remember, yeah.
So we go wherever our customers take us. Mostly a lot of our business now is driven by referral. When you've been in the business as long as we have, we're starting to sell houses to children of people we sold houses to, right? We're getting phone calls from our customers saying, I want you to help my son and daughter-in-law buy their first house.
Right.
Because we sold them their house back years and years and years ago. And yeah, so we've certainly sold, I think 1,200 is probably even a light number over that amount of time. And we do offer one of the most technologically advanced marketing strategies in the market, don't we?
Yes,
I think
do.
we've got a lot of different tools that we use to help create excitement in our listings.
Mm-hmm.
And at a time like this, when the market's shifting, when the market's changing, that's
important.
Very much.
Especially now that everything is going virtual. Technology is taking over.
Technology is taking over, isn't it? And we're finding ourselves on camera more instead of in person. We've got another Zoom listing appointment tomorrow night with someone who wants to sell, needs to sell,
mm-hmm.
but it's more comfortable doing it online the way we are now. And we've had to adapt to that, haven't we?
Yes. Although
one of the tools that we offer our team and use quite extensively is
mm-hmm.
video emails where people can see us just like they are right now.
That's right.
We've all been slowly embracing, perfect word, thank you. We've been slowly embracing that technology, but we know from statistics and from the industry leaders that we follow,
mm-hmm.
because we clearly don't know everything. There's people we look up to and people we follow and watch. And, what have they told us? That emails that have video is 95% likelihood of being opened.
That's right.
And a regular old typed out email, has about a 30% chance of being opened, much less read. And people really today like to communicate quickly, don't they?
Yes,
the strongest form of communication is what right now?
Video.
Yeah. And then next is probably text messages. And we even have a strategy for text messages, don't we?
Yes.
Our business coach taught us a strategy for text messages to communicate with people. And so, it's not as easy as it was back in 1995 and 1996 and 1997. We used to just put signs in the yard and put ads in the newspaper and houses would sell.
Mm-hmm.
And that's just clearly not the way it is anymore, is it?
No.
No, things have really changed. So there's our team, Risa and Ben and Andressa. Rice has been with us for a while now. She's a consistent $2 to $3 million a year producer. Ben, been with us a long time as well. Consistently does between $7 and $9 million a year. And Andressa's been with us for some time as well. And she can do a couple $1 million in production every year. She's a mother of two. Rice is a mother of two, right?
Yes.
Rice is a mother of two. Hi, Risa. Ben's got three children and some grandkids.
And
so
grandkids as well.
So he's busy. but collectively, that's the Chenore group. And every one of us has certain strengths. Every one of the people that you just saw there brings something different to the table. So we're thankful for that. But, clearly the market's changed and things have gotten a little bit different. Things have gotten a little bit uncomfortable. We were interviewed last week, weren't we, hon, about,
Yes.
we were interviewed last week by one of the people in our office, the leaders in the office, and you had said something about uncomfortable. What was that you had said?
Get comfortable being uncomfortable.
Right.
Yeah.
Right.
Things are going to change. COVID-19 has changed the landscape of every business in every part of the world. And I was thinking about the impact that we are having here in our country. And I thought, you know what? The rest of the world is not able to relate to us when we talked about 9/11. We cannot relate to the rest with the other things that have happened in other countries. We can't relate to that. However, the whole world today is able to relate with COVID-19. Every country around the world is going through the same thing. And every country around the world knows what everybody's talking about. I mean, everybody is just in their homes, having meetings through a computer, not being able to get out as much, and having to be careful with their kids and their parents. And it's just, everything is going to change. And that includes the real estate market.
Yeah, you make a really good point. Things happen around the world, you hear it on the news, and something happens in this country, something happens in that section of the globe, and we feel badly, we feel empathy, we feel all kinds of emotions, but at the end of the day, it's not here. So we still go to bed and wake up in the next day and put on our boots and clothes and go to work and do our buying and selling houses thing, and
Mm-hmm.
but what's happening in other areas just doesn't really affect us. But this, I think I saw a statistic that we talked about a couple days ago or yesterday. 97% of the country is home right now, and that never happens.
Yeah.
The biggest thing that happens is everybody watches the Super Bowl every year. That's the thing that everyone gathers around. Everybody's watching the Super Bowl, and by everybody, you're talking about 50 million, 60 million people. We're 330 million people in the United States alone.
Mm-hmm.
And 50, 60 million people, 70 million people watch the Super Bowl, and that's a ton of people.
Yeah.
Everyone in the world is at home right now because of this.
Yep.
And it's affecting every part of Congress. It's affecting everything. And it's affecting, how we do business, and it's affecting real estate to some degree too. So that's what we're here to talk about, right?
That's right. And lately we've been asked a lot of questions from our clients. So I gather the 5 most important questions that they're asking.
Okay.
And here they are. When is the economy going to recover? Are we going, or are at this point, into a recession? Is this going to be like 2008? And I think that most people are just assuming that that's going to be the point. And then what about job losses, and what should we do? So let's get started.
So that's what we're going to cover, huh?
We're going to cover all those questions.
Okay.
So
sounds like a lot.
It's not really. All right. When is the economy going to recover?
Well, so what happened? They put a big pause button on the economy, didn't we?
Everything stopped.
Everything
One
stopped.
day to the other.
From one day to the next, everything stopped. It's like hitting the brakes and the car stopped and just sitting in the car, aren't we?
Yeah.
Yeah.
So these
ahead.
are the models of the recovery, the type of recovery we're going to have.
We're predicted to have.
Correct. Yes. And they say it's going to be a V recovery. Right now, everything is on pause. From one day to the other, the economy just stopped. And so what's happening is we are seeing the consequence of that pause button right now. The economy is just going down, 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 down. As soon as we go back to work, as soon as we go back to some kind of normal, the recovery is going to stop.
which is maybe starting to happen now. You know,
Correct.
there's some states and some areas that are starting to go back into recovery mode or restart mode. And so, yeah, Goldman Sachs, JP Morgan, and Morgan Stanley, all three of them are predicting a V-shaped recovery, bottoming out sometime right there, you know, at the bottom of the screen in Q2. Well, we're in Q2 right now, right? Q1, January,
Yes.
February, March. Q2, April, May, June.
Mm-hmm.
And we're coming up on May 1st. So Q2 is when they're predicting is the bottom of this, what's going to be hopefully a V-shaped recovery, meaning there's going to be, just like, you know, like she says, there was a point where everything stopped, and that was right over here on the left side of the screen.
Mm-hmm.
And we've been drifting downward in economic production and GDP and everything else. And now we're at that bottom. We assume we're at that bottom, and the V is a sharp, now new incline. So those three major financial industries or financial leaders are predicting this V-shaped recovery, which should get us back above 0% GDP sometime right at the beginning of, or the early parts of Q3.
Q3, right. Now, some people are also talking about a U-shape type of recovery. Talk about that.
Well, a U-shaped recovery is, you know, instead of a V that's coming to a point down here where it almost seems like, and they've used this phrase before, turning the faucet back on. Instead of turning the faucet back on and the water rushing into the pail, a U-shaped recovery is more exactly that. We spend more time, a prolonged period of time, down in that bottom phase where things are starting to get started, for lack of a better way to put it. A U-shaped recovery would take longer to get back to the 0% GDP, get back above that production line. A U-shaped recovery would spend more time, likely would get into the third quarter before we start to see an increase in GDP.
Mm-hmm.
But these three that you're looking at here, Goldman, JP, and Morgan Stanley, you know, those are the three that we watch all the time, aren't they? You know, we follow them, we watch them, we read them, and they're usually pretty accurate. And that's why they're on our slide, because we trust them. And they're calling for this V. And I think we all feel like that's going to be, you know, that's going to be what happens.
I agree.
Historical analysis showed that pandemics are usually V-shaped, you know, sharp recessions that recover quickly. And like
since the amount of time of between the bottom and the recovery is such a short period of time, it's got a little damage on home prices.
Yeah, I mean, everything gets affected, right? I mean, we couldn't find toilet paper 3 weeks ago, 4 weeks ago, 5 weeks ago, you know, and car sales, you know, look at what the car industry is doing now. They're doing 2 and 3 and 4 months, no payments. Right. Because look, at the end of the day, you know, even though this is happening, people sometimes need to buy a car, don't they? I mean,
That's right.
I've got a lease that's coming up soon. I'm going to have to buy a car or not have a car. And so, you know, sometimes you just have to do things regardless of what the economy around you is, you know, might be telling you. And so the car industry is doing 2 months, 3 months, 4 months, no payments. Mm-hmm. The housing industry, luckily so far, hasn't seen much of a decline at all in value. We've seen a decline in one part of our real estate market. We've seen a decline in one facet, but we haven't seen a decline in value.
Right.
And that's pretty interesting. And that's something to definitely keep, you know, in the forefront of your mind if you're a buyer or seller today. Although clearly we're stay at home, clearly we're not supposed to go out, clearly we're not going to restaurants and bars anymore, and, you know, we're not going to sporting events and all those kinds of things. But, you know, your safe haven, which is what we've always called housing, your safe haven's still pretty safe.
Right. So explain this to me.
So it's worth looking back at history to place the potential impact of COVID-19 in V-shaped recovery. So what this is saying is, and a couple big words there, empirically, and they use it twice. You know, who uses the word empirically, first of all? And then second of all, the Harvard Business Review chooses to use it twice. They could have said it a lot easier. Remember when you were new and when I trained some of our newer people in our office, you know, when it comes to writing an addendum for a contract, what have I always said?
The simpler the better.
Write it like you'd say it.
Yeah.
Write it like you'd say it. You don't have to use these big giant wherefores and that, and you don't have to do that. What the Harvard Business Review here is saying is there is evidentiary proof that during pandemics, which is what we are in right now, and what the SARS pandemic was, the H3N2, the Hong Kong flu, H2N2, the Asian flu, the Spanish flu, those were all pandemics, just like
COVID-19.
COVID-19. Those are all the same type of thing. And what the Business Review here is saying is there is proof that during those types of events, these types of events, pandemics, V-shaped recoveries monopolize. In other words, V-shaped recoveries predominantly happen. The U that we talked about a little while ago, there's evidence that shows, no, you shouldn't expect that. We should expect there to be another V-shaped recovery. That's what they're saying here. Harvard Business Review is saying expect a V-shaped recovery, meaning we've been falling into this hole, and now we're hitting the bottom, and we're starting to claw out as a nation and as a world. We're starting to claw out. But again, I think the most important thing to keep in mind is housing hasn't been affected. And that's kind of why we decided to do this tonight, right? Because a lot of people are curious and questioning and afraid.
And there are a lot of people are nervous about the about losing their equity that they've worked hard for.
Right.
And people that need to buy are nervous about buying. So the next question to answer would be, are we in a recession?
Yes.
Absolutely.
Yes, we are. And recession is defined by a drop in GDP, a substantial drop in GDP, and we've had that.
Yes.
So there's been 2 recessions here to talk about.
The Great Recession from 2007 and 2009, which we all remember.
That was your first correction.
That was my first correction.
That was my second.
And that was your second, correct?
Yeah.
And the recession from 1990 and 1991, which, a lot of younger people don't really remember. So the only recession that they have this one to relate to would be the Great Recession from 2007, which was the crash of the housing market. So it's logical to think that people will expect the same thing today than 2007.
Right, because you only, in life you experience things and you go based on memory and what you know. And you're right, everybody that owns a house right now today, a greater percentage of them, probably 80%, owned a house back in 2007, 2008, 2009.
Correct.
I think every year, roughly about 15% of the buying population is a first-time home buyer.
Correct.
Right. So, realistically, a lot of people owned a home back then, and so they're thinking, oh my God, the same thing's going to happen again. And
that brings me to my next slide, which says recession does not equal a housing crisis. So this is a graph of the last 5 recessions, starting from 1980, which I guess you would remember because I was like 2 years old.
Well, and I was 16, so I don't really remember.
Okay, so 1980, 1981, 1991, 2001, which is the one I can relate, the first one I can relate because that was 9/11, and then 2008. And so 3 of the last 5 recessions have had appreciation, housing appreciation.
Or another way to say it is only 2 of the last 5 has there been a decline in home value.
Correct.
Only 2 of the last 5.
And I thought this was very interesting because I've never seen it this way.
Yeah.
I mean, I've never seen it explain it this way throughout the years.
And that red bar over on the right at 19.7%, that's a big loss, isn't it?
Yeah.
So it's not strange that people are afraid right now, and it's not strange that people are being cautious. So that's all they have to remember. Something
I had to add. I read a lot about the economy and the history of the economy, and it is to be expected that a recession will come every 10 years. if you look at the history of the economy in the United States, usually every 10 years we get some kind of recession. So even if you've seen this graph, 1980, 1981, then you have 91, that's 10 years. Then you have 2001, that's 10 years. Then 2008, which is 7 years. And now 2020.
Right, we're coming off a prolonged period of growth.
Correct.
We're coming off a prolonged period of growth. And so it was predictable that something like this was going to happen. I mean, you know,
everybody was expecting it.
Yeah, everybody was expecting it. And at the end of the day, everything in life is a circle. Everything in life is a circle.
Right.
You know, the circle of life. Everything in life is a circle. And we're always coming back to that one point again. And like you're saying, every 10 years or so, you can count on, and I don't like to use the word recession as much as I like to use reset. But yeah, you can count on a reset, you know, every decade just about.
Yep. So the next question, and this is the big one, is this going to be like 2008? And
No.
Why?
No, it's not. It's completely different from 2008. And I hope you noticed how quickly I answered that question. First, you asked me, are we in a recession? Yes. You didn't even get it out of your mouth. And I said, yes. Is this going to be like 2008? No, not at all. And, you know, and I've said this to people for the longest time. In 2008, you know, if you could fog a mirror, if you had a pulse, you could get a loan for $500,000 house. And lenders would tell you, don't worry about the payment. Don't worry about it. In 6 months, you'll refinance it and you're going to pull a ton of money out of your house and it'll all be good because the house keeps going up in value. And people were looking at their houses like they were, remember I used to say they looked at their house like it was an ATM. You know, they could just keep pulling money out.
Yeah.
And, you know, and for the longest time, you and I would go to listing appointments for people who wanted to sell their house. And I say this all the time. We would pull up in front of their house, a big, giant, beautiful house, and there'd be 2 brand new Lexus motor cars and Mercedes cars in their driveway. And we'd go inside and, you know, we'd knock on the door and they'd answer the door with Rolex watches and big diamond rings and no furniture in the house.
Yeah.
You know, they bought this big ostentatious house and couldn't afford to furnish it. And if you can't afford to furnish it, what's next you can't afford? You can't afford to keep it.
Right.
And so, you know, short sales became something. So, you know, what this is saying, you know, what's this saying here? Many still.
Well, I want to concentrate on the last phrase. It says, where the housing led the recession in 2008, this time the housing market may be poised to bring us out of it.
And I think it is poised to bring us out of it. In 2006 and 2007 and 2008, if you had a pulse, you could get a loan.
Yeah, it's not.
That's just the way the mortgage industry worked. Today, it's actually the way it's supposed to be.
Right.
It's difficult to get a mortgage. I mean, we just were at a walkthrough yesterday, weren't we? And the buyers said, Jesus, you know, I'm so glad this is done because my lender kept asking me for more documents and more documents and more documents. And we'd already given them this stuff 3 times and they wanted it again. And well, that's the way it's supposed to be.
That's the way it's supposed to be.
You know, you're borrowing hundreds of thousands of dollars from somebody who has it. And it's the old golden rule. He who has the gold rules. And so if a bank wants to update your income, wants to update your verification, verify your employment, if they want to do these things 10 times, they're the ones with the money. You're the one asking for it. You're going to have to just do what they say. And you know, while some lenders' policies can be a little bit exorbitant, for the most part, they're all in line with Fannie and Freddie, and all they're doing is protecting their investment.
That's right.
That's all they're doing.
I thought this graph was interesting because the red one is the appreciation percentage that we had 6 years before the Great Recession in 2008. And we can see that houses were appreciating 12, 11, 9% every year. And now, the 6 year prior to this recession, houses have only been appreciating 4.4 to 6% at the max.
Yeah, so the highest in the last 6 years here, you know, recent is 6.4%, and that's half of what the highest was back in 2004. I mean, back in those days, I remember going on listing appointments with people, and I would say to them, you know, hey, how much is your mortgage payment? And they'd say, $3,000. Congratulations, your house went up in value that much last month. Last month. Yeah. You know, the housing prices were just going crazy. Remember, I used to say, back in the day, I drove a Corvette back then, didn't I?
Mm-hmm.
And I used to say to people, if I get a flat tire in my Corvette, I got to take it somewhere, and some guy in blue has to fix my tire.
Mm-hmm.
Well, that guy in blue deserves to own a house too, but
And
he
it was
couldn't back then.
impossible.
It was impossible.
They were
3-bed,
too
2-bath
expensive.
starter houses, 1,500 feet, were $450,000.
Yeah.
And we remember asking people, we'd sit with them and, we're listing their house for $450,000 because that's what it was worth back. That's what it could sell for back then.
Mm-hmm.
I submit it was never worth that.
Mm-hmm.
And I would say to people as we're signing the documents, I'd look at them and, kind of grin and say, seriously, do you really think this house is worth $450,000? And they're like, no, but that's what it's going to sell for.
Yeah.
And that's represented right here, that houses were just going up in value so high. And then that caused a big problem.
Right. The higher it goes, the higher it falls, right?
Well,
the faster it falls, I guess. So explain this.
Oh, that's just a graph showing, what happened, that there were, it was easier to obtain a loan back in 2004, 5, and 6
Mm-hmm.
Than it is today. This graph is just showing you that
It is what it should be. It's a flat line, basically.
Yeah. The taller the graph, the easier it is to get a loan. The 868.7 and the 181.3, that's just an availability index. It's showing, 886.87% of the time you were able to obtain a loan is, I think, what they're kind of saying here.
Yeah.
Here they're saying 18% of the time.
Right.
And
so back comparing 2007 today, in 2007, months of inventory of homes for sale was 8.2. Today was 3.1.
And I hinted at that a little earlier. I said that there's a problem. There's one part of our industry right now that is suffering a little bit, and it's not value. It's not home value. The one part of our real estate world right now that's suffering is right here. Inventory.
Correct.
We have only got 3 months of inventory on the books right now, and back then, we had 8. There was a lot more houses for sale. Today, there's just not very much. We're asked by people right now, aren't we? Should I put my house on the market today, or should I wait for this thing to be over? Show them this graph, and clearly you should put your house on the market today during the pandemic, because there's a lot less people trying to sell right now. And
Correct.
like I said earlier, I need to buy a car. People need to buy houses sometimes, don't they?
Yes, they do.
Job transfers, death, divorce, whatever. People sometimes need to buy houses. Regardless of what's going on, I got to buy a house. Right. And, I would rather be a seller when there's not a lot of sellers out there.
Correct. And which is today.
And this was pretty powerful.
It is, isn't it? So
this is saying back in 2005, 6, and 7, during that 3-year period before the crash, $824 billion was pulled out of houses
as equity
in refinancing.
Mm-hmm.
$824 billion worth of inflated value of your house was pulled out so that you could go on vacation, buy nice cars, get new clothes, whatever. $824 billion. And then look at the last 3 years, when after the crash, and I talk about it all the time, Dodd-Frank tightened up the lending industry, didn't it?
Yes.
And it became much more difficult to obtain a loan. It became real to obtain a loan. And now we as an industry have our hands all around the mortgage industry and the real estate industry. And we're showing you here that almost down 75% decrease in how much equity is being taken out in refinance, billions now. I mean, this is just showing how
it's 1/4, basically.
Yeah. And what it's saying on the left is your house was worth a ton of money and you could go ahead and take it out and do whatever you want with it. What it's saying on the right is your house has still got a lot of value, but
people are not refinancing and taking equity anymore as much. Actually, I read something yesterday that said that 50% of the homeowners in the United States have at least 50% in equity in their homes, which is pretty high. It's a pretty high number. People have learned to just, not get all the money out of the houses.
Right, because it's not an ATM.
Right. I mean, you don't do that with your 401k, do you?
No.
Right. So what about all those job losses? Let's take a look at that. Wow. That's
So, yeah, 3.3 million the week of March 15, 21, 6.6 million, 21, 22 to 28. The real statistic today is there's about 17 million people unemployed right now.
now let's crunch that number though, because most of the people that are claiming unemployment are going to have a job when all this is over.
Yeah, I mean, that's the belief, because a lot of them are being furloughed, as businesses contract because there's no income. And everyone's going for those payment protection plan loans and things that the government's trying to do, and don't start me on that. I think it's a great plan, but it's not being
Implemented correctly.
It's not being implemented correctly, and people, my God, the Lakers got millions and millions and millions of dollars. The Lakers, the basketball team, the LA Lakers, is worth $4 billion or something, and they're getting loans for tens of millions of dollars. They don't need that. They're giving it back. Some of these companies are getting caught with their pants down, their hands in the cookie jar, and so they're giving it back. The small companies, we used to get a sub sandwich from a place that we really liked right by near the office, right?
Yes.
And it went out of business.
Yeah.
That guy needs the loan so that he can come back to business.
Right.
Some of these big giant conglomerates don't need the money. But go back to that slide for a second, though. Can you go back?
Okay.
Yeah. What we were talking about is people are being furloughed. So a lot of these businesses, we hope and pray, are going to come back. And when they do come back, clearly the easiest and best thing to do is hire the people back that were working for you, because they're already trained. They already know your customer base. They already know what their job is.
Right.
Let's just get back to work. And so hopefully that's going to be what happens. It just depends on how much we keep turning the spigot and letting the economy start to go again. The last thing we need to see is, the rate of infection and the rate of people dying start to increase again.
Mm-hmm.
The last 6 weeks have been painful, but we at least have a cap on things, don't we?
Right.
And if it all starts to explode again, wow, I don't know what to think then. But yeah, there's a lot of unemployment, but a lot of it is furloughed workers that hopefully are going to go back to work. A lot of lenders are giving
incentives
and loan forbearance. Don't make your payment for a month or two. You got to read the fine print. I'm not telling people don't make your mortgage payment because you can get away without making your mortgage payment. I'm not telling you that. You got to read the fine print. There's fine print. But a lot of banks, a lot of lenders, a lot of businesses are realizing that if we don't all work together, we're toast.
Yep. So unemployment rates and home sales do not have a direct relationship.
Clearly.
Obviously.
Clearly. I mean, anyone can read that graph. The fact that there's unemployment doesn't really ever stop. And if you look from 1989 to 2005, home sales kept on just kind of creeping up and up and up and up and up, didn't they? And then bam, then we had the correction. And, the overall trend from 2006-07 to 2019 is still an upward trend in home sales.
Yeah. Now that yellow line is going to go up all of a sudden.
Yeah, it is.
Yeah.
At the end of the day, though, back to the safe haven thing, your home is your safe haven. And, home ownership is the American dream. Everybody wants to own a home.
Yeah.
And so this is showing you that.
And we're all quarantined. So, and where are you? Home.
Yeah, you're home.
So this is a question that I get asked every day. And a lot of people are just holding off and waiting to see what's going to happen. But most of the people that are looking to buy right now are thinking that in 6 months from today, there is going to be a big drop in pricing. Let's discuss that.
Yeah, everybody says that. People are saying, hey, I'm going to wait because, you can't show my house anyway. Or I'm going to wait because there's going to be, the prices are going to come down, and then I'm going to be able to buy low. And again, all they can relate is
to the Great Recession of 2008. And so it's hard for them to think that there's no relationship between a recession and home pricing.
Right. They think if they wait, they're going to get a house for less money. And the reality, the facts are showing us that house values are not going down. In fact, house values are at least staying steady.
Right.
And in a lot of neighborhoods and in a lot of geographic areas, house values are still escalating. They're still going up.
Yeah.
And so, this is real good. A few slides ago, we said right now we've got 3.1 months worth of inventory, right?
Correct. And so this is what? A seller's market.
When there's less than 6 months worth of inventory on available at any one time, it's a seller's market. And our inventory is at half that rate right now, 3.1. We've got 3.1 months worth of inventory. It is clearly right smack dab in the middle of a seller's market. So even though there's,
now that number is nationwide.
Yeah.
And we'll go into local numbers.
Yeah, in a few seconds. But a neutral market, we're nowhere near a neutral market, and we're nowhere near a buyer's market right now. It is a seller's market. Now, are there areas and neighborhoods and houses in general that may or may not be able to hold this true? Yeah, sure, of course. We can sit here and tell stories about that house sold for $600,000 and this is the same house that sold for $400,000. Well, there's a reason for that. And that's not to talk about right now. But, overall, it is a seller's market right now. So the smart money, if you're a seller, you're putting your house on the market now. Two things. We still can show houses. We can do it virtually. We've done that now. We've adjusted to that. We're bought that gimbal and we're able to walk through houses. We did it today, didn't we?
Yes.
We went and walked through a big house in Davie, a $900,000 house, because we were filming it for a client. And when he got the video, he's like, "Oh my God, I love it!" So people say you'll never buy a house on video. Well, people find their wife online. People buy a car online. It's getting to where people are going to buy houses online. And so if a seller says, "Well, I don't want to put my house on the market because people can't show it anyway because you can't leave your house," well, that's not true. The real estate industry, part of the financial industry, is essential, right? And so we've been able to come and go. We've been able to, although we can't go to our offices, we can still go to houses and show buyers houses and do all. We got to do the COVID stuff, masks and
gloves,
booties and gloves and sanitizer, and it's uncomfortable and it's unusual, but
it still can be done.
We're still selling houses.
That's right. And so let's talk about Broward County.
Oh, okay.
So this is last year against this year.
Mm-hmm.
And this is for the end of March to 2020. So we have 3.7 months of inventory.
And the same time last year we had 4.7. So we've shaved a month off of a full month off of our months of supply. And what's that saying? I mean, my gosh, houses are selling.
Right.
Look at the dollar volume. 603 million versus 673 million. Look at the median price, up to 390 from 365.
Yeah.
Look at the time on contract, median time on contract, 55 days last year, 43 days. Stuff selling faster, isn't it? Time to sale, 95 versus 82. Stuff selling faster, isn't it?
Mm-hmm.
The number of cash buyers has gone down. Oh, I'm just going to wait for that cash buyer. Someone will pay cash. No one's paying cash anymore. And why are people not paying cash?
Money is cheap.
2.3%, 2.7%, 3.1%. Why would you pay cash? Borrow someone else's money. But look at the closed sales. Yeah. Closed sales in 2019, closed sales 2020. They are the same, man.
Right.
So.
And that is for single family homes. And then the condo market, we know it's different, but it doesn't look much different from last year.
No, but the few things that we wanted to look at, the months of supply is down slightly.
Slightly, but it's borderline to a neutral market.
Active inventory is down.
Yeah.
Dollar volume is up. Median sale price is up. Look at that though, 50% are paying cash in the condo and townhouse market.
Yeah.
And closed sales actually more than last year. Now, time on market is different than in the residential say residential end. 51 days to get a contract, 93 days to sell. Townhouses and condos are a little bit different and a little harder to sell because there's oftentimes more restrictions, condo documents, homeowners association, things like that, lack of ample parking, common area elements that may or may not be used a lot by people and they don't want to pay for them. So, the condo buyer, the townhouse buyer can sometimes be a little bit more unique animal than a single family house buyer, simply because of some of the amenities that you're forced to pay into with these maintenance fees.
Correct.
So it's not surprising that these numbers are what they are. But overall, still not dramatically different than last year. Median time to sale last year, 90 days. Median time to sale today, 93.
Right.
Nothing surprising.
The cost of waiting, and I put this in because as a buyer, if you're wondering what's the difference for you to wait to buy a house today and buy a house at the end of the year. Today, the interest rate is 3.45. If the interest rates go up by the end of the year,
and that's projected that likely could happen,
it's actually going to cost you more to buy a house at the end of the year than to buy a house today.
Yeah.
Because the interest rates are projected to go up.
That's
they
always
can't
the
keep
struggle.
That low.
It can't stay that low. That's always the struggle. I can remember selling houses when interest rates were 12, 14, and 16%. I mean, that was just crazy. And I when we're working with some buyers sometimes, I can't help myself but inside to laugh when I hear someone say, I don't want to pay 4.5%. And I just think to myself, try paying 4 times that.
Yeah.
And it's all relative. But yeah, oftentimes if you wait, it ends up costing you money because either A, the cost of the house is going to go up because everything we're talking about right now tonight, I don't know how long we've been on doing this, but everything we've been saying is your house is not going down in value.
Correct.
In fact, it's continuing to stay steady or maybe even go up during this pandemic. So waiting until tomorrow, if history holds, go back 15 slides, if history holds, then you're going to pay more for your house if you wait. You're going to pay more for the next house.
Let's talk about that. We have little time of months of inventory right now. So if you are a seller, let's put ourselves on the seller side and let's put ourselves on the buyer side. If you are a seller and you're waiting to sell your house, is that the thing to do, or you should sell today? Why?
You should put your house on the market today, now. And here's why. Everyone believes there's going to be a lot of pent up demand and a lot of people waiting to put their house on the market that ordinarily would have put their house on the market now. It's true. There are a lot of people even telling us, I'm going to wait, I'm going to wait, I'm going to wait. And if that's what they want to do, we don't try to talk someone out of what they want to do. Right. We just do like we're doing now. Provide them with facts, provide them with data, and educate them and give them the most we can give them so that they can make a good decision. That's our role. We're guides, aren't we? And we try to guide people to make the right decisions. If I'm a seller, if I'm sitting with a seller, I'm doing everything I can to explain to a seller, put your house on the market today, because there are fewer houses on the market today than there will be in 3 months when this thing starts to hopefully calm down. Do you want to be one of 6 houses that goes on the market today? Or do you want to be one of 66 houses that goes on the market in 3 weeks, 3 months?
Right.
Because I say this all the time, when there's more inventory, what does that do? It puts downward pressure on pricing.
Correct.
Right? I say it all the time. There's 15,000 houses in Broward County for sale today. 15,000 people are going to bed saying, please, somebody buy my house. And what do? We always tell people, our job is to create excitement and activity around your house so that someone chooses to buy your house instead of one of the other 15,000 that are for sale. Well, we don't have 15,000 for sale right now. We don't have a lot of people putting houses on the market right now. So the smart money is put it on the market now. Deal with the COVID restrictions that we all have to handle. Yeah, you're going to have to wipe things down. Yeah, you're going to have strangers in the house, but we can handle all that. There's things that we do, and we all know what to do. You put your house on the market now, you're one of 6. You put your house on the market in 3 months, you're one of 66. Which sounds better? Right. Now, you're a buyer. You wanted to talk the other side.
Correct.
Okay, well, there's going to be 66 houses for sale. So I want to wait for one of those 66 houses because that's what you just said, Jeff.
Yes.
Okay, same thing. There are all kinds of buyers sitting on the fence waiting because they think they're going to get a lower price.
Right.
And when this thing relaxes and the sellers go, release the hounds, list my house, the buyers are going to all jump off the fence and go, let's go buy a house. And you're going to be competing with multiple offers for houses that have gone up in value while you were sitting on the fence. And you're going to be one of 10 people trying to buy that house instead of being maybe the only person trying to buy that house right now.
Right.
So an argument could be made on both sides. List it now, be one of 6. Buy
And
it
it's all
now.
relative, because if you say there's a lot of listings coming, then there's a lot of buyers coming at the same time. So the
And what
market is
happens?
going to keep being the same.
And what happens when there's more buyers for one piece of product? The price goes up.
Yeah.
And so if we all wait to buy houses for 66 days and all of us buyers jump out and go, okay, now I want to buy. The minute you write an offer, if someone else is writing an offer at the same time, and that will happen, price of that house just went up because now you're playing against each other. And the seller's just
but
going
that
to sit
doesn't
back.
necessarily means that the house will appraise, and that's
It doesn't
a
mean that the
whole
house
other
is going to
thing.
appraise.
Yes.
That's the whole other animal. But it's today, I would rather be one of 1 or 2 people trying to buy that house instead of one of 10 or 20 people trying to buy that house.
Correct.
So an argument can be made each way.
Yeah. Okay. So.
Oh.
Well, yeah.
This is a good one.
Now, tell them what you tell me all the time about your 401k.
So 5 weeks ago, 6 weeks ago, when this thing started, all of us saw our 401ks, all of our investment portfolios tank in a day by like 30%, right? Remember that?
Yep.
And we're all going, oh my God. And what did I always tell you? What have I always said? Don't look at it.
Don't look at it. Yeah.
It's not today's money. That's 20 years from now's money. It doesn't matter. It'll come back. And usually it does. But look what's happened. Look where people look at what the best investment is today and always has been in the United States of America, your house.
Right.
Because when all the crap hit the fan and they told us, you got to stay, you don't go to work, don't go to social events, don't go to sporting events, don't go to the restaurant, don't go to the gas station, don't go to the grocery store. Where'd they tell you to go? They told you to go home.
That's right.
They told you to go home. They didn't tell you to go sit and look at your gold. They didn't tell you to go look at your stocks at the investment house. And they didn't tell you to go sit inside your passbook savings account. They told you to go home, which is the safest, strongest investment someone can make. So,
and that shows.
And that shows.
Exactly. All right.
Oh.
Okay. So I haven't got any questions right now. So this is our website, our Facebook group. We're on Instagram, and that's our email. So let's connect. If you have any questions, send us a message and we'll respond right away. If you want to have a private session with us, we're happy to. So just connect with us.
And so to be clear, those were questions that were sent in by people that they wanted to have answered.
That's right. Yes.
And so that's what this all came from.
Yeah.
Well,
I was getting questions from a lot of people, and so I gathered all their thoughts, and I just put the 5 main questions that needed some talking.
Well, this was fun. I think it was fun, and I hope it was informative.
Yeah. Thank you everyone for coming.
Yeah, thank you for coming and being a part of it, and hopefully some of it made some sense. It's all fact and data driven, so but yeah, connect with us any way there that you can. If you've got some unique questions that you want us to answer, then we're happy to do that. But hopefully this helped a little bit. And everybody, I guess the last thing I'll say, wash your hands.
All right. Okay. Thank you, everyone.
Bye.
Bye.